Robinhood shares sliding here as fourth quarter revenue missed expectations. Joining me now is Christian Bolu, senior analyst at Autonomous Research. Christian, it's good to see you. So Robinhood reports we're down right now, nearly 8% in the after hours. Christian, what do you make of the print? Your first thoughts?
Yeah, afternoon and now evening. Thanks. Good to see you. I would say, look, an expensive stock and a top line miss is not helpful at all. Also, there was some deceleration in some key metrics. Things like the net deposit growth decelerated in the fourth quarter and looks to have continued to decelerate in January. So I do think the reaction might be warranted here, just given high expectations and I would say obviously a very expensive stock. That being said, the commentary from the management team is pretty constructive in terms of the pipeline for 2026 in terms of new business growth, and actually transaction volumes have been very strong in January as well. So the outlook here is actually pretty decent.
Let me ask you, Christian, heading into this print, the stock was already, it was off about 40% from that all-time high in October. And a big question, this, of course, for investors right now is they're trying to gauge how this company is going to navigate, Christian, this crypto winter, right?
Yeah.
This route in Bitcoin. You know this company backwards and forwards. As an analyst, how do you think about that? What is it going to mean, Christian, for Robinhood's trading volumes, for EBITDA? How do you model it?
Yeah, so crypto has fallen as a percent of revenues. It's come down from north of 20, and over time we think it will be near a 10% of the business. If you run through what a crypto winter would look like, so if you look at where trading volumes troughed in 2022, 2023, it would imply something like a 50% haircut to current trading volumes. If you run that through the P&L, it's only about a 10% hit to Robinhood. So Robinhood's EBITDA. So not great, but completely manageable. In fact, over time, we think things like event contracts and prediction markets will be a bigger part of the business, and than crypto. And obviously, the actual biggest business, which is options trading, continues to do extremely well with really strong volumes or record volumes to start 2026.
Christian, would you argue that Robinhood, are they in any way better positioned during this Bitcoin drawdown than prior drawdowns because they've diversified the product lineup or the regulatory backdrop? I'm curious to get your thoughts there.
Yeah, it's definitely a different winter. I would say we are surprised about how severe crypto prices have come, given we should have a more constructive backdrop for crypto. And so it's been somewhat surprising. But from Robinhood's business perspective, they're definitely better set up. This is a much more mature company, a much more diversified company, not just in terms of the types of transaction businesses it has, but also just the types of businesses it has. It has a net interest income is a much bigger part of the revenue stream. They have things like retirement, launching a banking product with credit cards. So this is much more of a money app that is in many, many businesses and way more diversified than in prior periods. And just from a business perspective, better managed, more disciplined on expenses, very profitable company. So all these things set up the company very well for, let's say, a crypto winter.
What about options trading, Christian? Because as you know, listen, biggest business for the company. I think it's something like 25%, Christian, of revenue. What are the catalysts you see ahead for that business?
I would like the businesses a lot here. So options, for the most part, have been options penetration, i.e., just how many options have been used relative to the underlying equity market, has been growing for the last 30 years. And has only accelerated in recent times, partly because of firms like Robinhood that have made it easier to use and understand and increased accessibility. Also, products like zero-dated options that give you much more precision around risk management have also driven significant adoption of options. So we'll do some analysis on this, and we think you could see something like 40% incremental growth in the options business because of all the penetration we're seeing, the new products, and a normalization of what we call options penetration. So, pretty constructive on options. And as I said, that's the biggest business. It's less cyclical, believe it or not, because people can trade options in up and down markets. It can be used to generate yield. It's a very flexible product. And Robinhood offers basically the best value. They charge the least relative to the bigger players out there. So there's a value prop from using the platform. There's a great UI, and the underlying market is growing very fast. So I think a really good business for Robinhood long term.
You mentioned, Christian, the company's moving to prediction markets. How confident are you about the growth story there long term, Christian? Especially, listen, they certainly have plenty of competition, right?
Yeah, it's a good point. So there's a lot of competition. The good thing about Robinhood is their value prop from a business perspective is the distribution. There's not many folks that can distribute or have the distribution that they do. So there could be a lot of competition around the products, Kalshi, Polymarket, the exchanges. Everybody can launch their own product, but they all still need the pipes to distribute that through. And that's where Robinhood really stands out. It's not just that they have the numbers, they have the type of customers that really, where prediction markets really appeal to. And you see it in the numbers. So despite the increasing competition, I actually see Robinhood coming out as a winner here. And if anything, they can actually monetize better over time as they build their own platform, right? They just announced a partnership with Susquehanna that gives them much more control of the economics, gives them much more ability to be faster around product innovation. And prediction markets are tiny relative to broader futures markets, broader options markets. So the pathway for growth here is pretty significant.
Here we are, the S&P 500 is near a record, right? We've seen stocks sort of rise here. It doesn't feel like it though, does it? I don't know. What do you, the sentiment here, just like we were talking a lot about the vibe session or whatever, that people didn't feel good even if the economic numbers looked good. Right now it feels like we're in a little bit of a similar situation with the market. What do you think?
Yeah, I think there's a lot of moving pieces to that dynamic. Certainly the market has kind of climbed a wall of worry over the past few years. It's actually one of the most persistent rallies on a 3-year basis or a 4-year basis we've had in quite a while. However, I think there's another dynamic to this, which is what's going on with the dollar and dollar debasement. And if you look at the stock market, say the past 20 years or so, it's not actually up versus if you price it in gold or something of that nature. So there's certainly an argument that if the dollar loses value, just to keep pace, the stock market has to go up proportionally. I think that's part of what we're seeing there. Interesting.
Okay, so do you feel like the reasons that the stock market has gone up or not? I mean, there are fundamentals to support increases still, however, right?
Yeah, absolutely. I mean, if you look at overall earnings growth, they've been pretty good. I mean, certainly there's been concern around software names, but it looks like energy is having a bit of a comeback. So there certainly are some fundamental reasons for that. And gold is certainly up considerably regardless. It's not just an inflation story.
Right. So, okay, so the software sell-off, would that be something have you come in and bought some of those names?
So we haven't. So there are some real concerns about some of those software names. I think at the end of the day, AI is going to be a net positive for certain software names, and others it's a huge net negative where they can actually be outright replaced. But I think if you look at a company like, maybe one exception is we bought into some ServiceNow, and ServiceNow is one of those companies where I think they'll probably be a net beneficiary of AI. Whereas you look at a company like, let's say, a Monday.com, and it's pretty easy to replicate some of their services through some of these vibe coding type apps.
Okay, so what's the difference between a Monday.com and a ServiceNow in terms of why does ServiceNow have a bigger moat than say a Monday.com?
So first, it's pretty difficult to replicate because there's a lot of infrastructure that needs to be in place for companies that have large customer service operations. So I think that's certainly a benefit that ServiceNow has, whereas Monday.com is a relatively simple piece of software that can be replicated at least for, say, 80-90% of the use cases without that much difficulty.
Gotcha. Okay, so selective buying in software. What about, I mean, you mentioned energy, which is the best performing group this year thus far after lagging, for a while. Is that, so are you participating in this whole rotation that we have seen into some of those kinds of areas, industrials, consumer staples, et cetera?
So we haven't rotated our portfolio a whole lot. We've held a little bit of energy names. We own some Marathon, we own some Talon, but if you look at our portfolio more overall, I'd consider it to be more like durable compounders.
What does that mean?
What that mean is more companies like a Visa or a MasterCard or a Meta, those types of firms that have strong moats that consistently grow their earnings with high margins, high return on equity, high return on capital.
And I want to also talk about some of the other asset classes, right? Because you mentioned gold. And I think that regular investors who sort of got in and then were whipsawed are struggling to figure out what to do now when it comes to gold and silver, because there's the fundamental case, just like there is for stocks, and then there's sort of the technical effects of what happens when people get positioned in a certain way and then have to make up for that. So how do you square those various things?
Sure. So I guess there's lots of things moving at the same time. So I'd say you'd have the deep currents, which are things like central bank buying or deficit spending on the US federal government level. And those are very strong deep currents. And they likely will take gold higher in a big way the next 3, 5, 10 years. But then you also have some of these things like the recent Fed appointment, which make it unclear. Are we headed for a stronger dollar or a weaker dollar? They're kind of saying two different things. It's not clear. It's clear what Trump kind of conceptually wants, but it's not clear how much Fed independence there really will or won't be. And increases in margin requirements, some of these violent moves like we had in gold or even more so in silver, I think will create a very volatile rally over the next 3 to 5 years. But it's going to be one where you have to wear your seatbelt.
And what about crypto? Does that fall into a similar category?
So I think crypto has kind of lost that digital gold story, and it's become much more clear that it's more just a high beta asset. And I think, frankly, there have been a lot of things distracting people from crypto. Crypto at one point was the real meme stock equivalent, whereas now you have crypto, but you also have meme stocks, you have gold, you have silver, you have a real betification across the economy, and I think that has taken a lot of the capital flows away from crypto.
That's a really interesting thesis. I mean, and we see it also in the single stock movements, not even just meme stocks, but other types of stocks that normally you wouldn't think would move that much are moving a lot. Do you think there's also, because of the crypto washout, that has pushed a lot of money into some of those memes instead?
Yeah, or I mean, I think the memes have attracted a lot of money that might have otherwise gone to crypto.
Gotcha. So does that mean you don't want to be positioned in crypto?
I think crypto is a very binary story, and it's very unclear what that future will look like. It'll either be much, much higher 10, 20 years from now, or it could be that Bitcoin was a fad, or it could get hacked, or people might just not have that appeal to it like they did previously.
Promotions by retailers keep coming earlier and earlier. So maybe people spend all the money in November, and then they were done with all their holiday shopping by December. Is that a realistic way to think about it? What do you think?
I think that the data coming in this morning is very interesting. When we look at year over year data, what we're seeing is actually a stronger than expected holiday season. Holiday spend was up 6.4% year over year across all generations, and that includes all payment types. So we're talking credit card, debit, buy now, pay later, even SNAP is included in our numbers. So when you break that down to your point about K-curve economy, it does validate that we are in a K-curve economy. The high income cohort, 125K household income or higher, spent 29% more on holiday year over year, where the mid and low income cohorts actually pulled back about 4%. And their share also changed. It went down about 2.2 to 5%, and the high income share increased, share of total holiday spend, by about 7%. So we do see that divergence. So although it's a story about growth year over year, there's certainly a bifurcation between income cohorts. And to your point, we know the low and middle income cohort are spending more of their wallets on essentials, cost of living expenses, leaving left over for holiday.
I mean, and this is what we've been hearing from companies also, specific. I mean, we were talking earlier about Coca-Cola and all of these consumer products retailers that are trying to tweak their offerings, tweak their pricing, figure out what the sweet spot is that keeps people buying their products, but at the same time doesn't like wither away their margins.
Yeah, and what we were talking about was this key lingo word within the industry was price pack architecture, where everyone's trying to switch around just how many cans are included within the Coca-Cola pack. And that's what we heard from Coca-Cola's CEO when I was on the phone with him this morning. He ultimately said that they're playing into this, that the low-income consumer is playing into value, even going to more dollar stores in order to get the best bang for their buck. But as we've heard from many different C-suite executives, is that the K-shaped economy is continuing, and also value is super important. Take a listen to what people have been telling us so far this season.
60% of our consumers' average household income is over $100,000 a year, and they're still spending in this tough economy.
The middle, lower income consumer, quite stable, same as last quarter, but still very stretched in their budgets, trying to be choiceful and cautious on how they spend their money.
1 out of 3 units now that we move are everyday essentials. And what we find there is that the more the customers can rely on us for everyday essentials and the lower ASP items, they just choose to do more of their downstream shopping with us.
And what's so interesting is just consumers really focusing in on essentials, as you noted, but also these companies trying to tackle, okay, we have higher costs, higher prices, maybe because of those tariffs that are finally going through, and we want consumers to ultimately buy more still in this environment where they're still choiceful and cautious, or like the words we've been hearing over and over again.
Well, I guess the question is, Allie, what's going to change this?
Right.
Oh, that's a great question. So what could ease this K-curve economy?
Yeah.
So a few things, right? We could see inflation that's been pretty persistent subside a bit. That could help. The housing market could improve. We did see some slight improvement in the back half of calendar 25. If that continues or improves further, that could help. We also are seeing this disconnect between GDP growth and GDP projected growth and wage growth.
Right.
If that gap closes, that could also improve, right? We're not seeing super high unemployment, but we're seeing higher than usual underemployment. So people that have part-time jobs are having trouble getting full-time jobs, and people that don't yet have jobs, it's a little harder in this environment to get a job. And a lot of those are younger generations of consumers under 30, and that's our future consumer. So if that improves, which it might, because you have disruptions out there like weight loss drugs, I talk about that all the time, right? New brands, new products, new industries could be created through this physiological disruption. We could see improvement.
I was looking at some of the figures around wage growth versus consumer inflation, headline consumer inflation. And wage growth over the past couple of years has actually come back and is outpacing inflation. There you see what happened sort of post-pandemic. But I think a couple of things are going on. One, the perception is still that inflation is hot, and it is hot in certain items. And secondly, the overall price increase, the total price increase, is still eating into the share of spend on various items, right? So, I mean, maybe it's not just, I guess what I'm saying is it's not just that inflation has to ease, like something more fundamental, it seems, has to change perhaps with psyche.
We saw PepsiCo lower prices, right?
Oh yeah, we did. But then we see a company like Hershey, kind of ride along with inflation and have a lot of success. But they're also shifting their portfolio significantly towards more snacks that correlate to wellness, right? They're riding that trend.
Like popcorn?
Yeah, exactly. Pirate Booty is one of them. Necessary Evil they recently acquired.
Yeah, that's a good one.
Dots pretzels, right? So some of those are performing really well in the current environment.
And they don't include cocoa, which has been so inflationary, which has been pushing up the prices.
Right.
Exactly.
Yeah.
I mean, the other thing that you have to really focus in on is we are still seeing a resilient consumer. There is a significant say versus do gap, particularly these younger generations. I mean, when we first surveyed in the summer about holiday, Gen Z told us they were going to pull back 23%. Well, fast forward to the actuals, they spent 21% more year over year, right? So to your point, there's a perception out there that everything, prices are high and inflation has a significant impact, but then what consumers actually do is often very different than the sentiment.
And what was so interesting too on that same younger consumer was that Chipotle CEO actually said on the call that 18 to 24-year-olds has been pulling back, and this quarter they gamified the process, gamified the ability on their app, sort of making freebies and getting different rewards by doing different things, and that brought back in that younger generation. So it's all about like trying to get that consumer where they're at and what they want to engage with the brand.
I'm also curious what money they're spending. In other words, do they have this cash? Are they using buy now, pay later? Are they using credit cards? Because if they're not,
you're like,
because if they're not getting jobs at the rate that they want, are mom and dad who are invested in the stock market helping fund some of this?
Yeah. I could speak to this a little bit. So a few interesting points. Number one, credit card delinquency rates of people 30 and under are about 10%. The national average is 3%. So we do see this generation having higher credit card delinquency than other generations. Number two, this is a Gen Z in particular. They're a paradoxical generation. They're the most cost conscious we've ever seen any generation be, but yet they're willing to splurge on things that provide joy, give them social status, speak to self-improvement, and they also splurge on experiences. So, they have some money and they're willing to spend it on those types of things. The other point, they only made up about 5.6% of total holiday spend share, whereas a generation like baby boomers made up, 34% of share, just to, give you some dimensionalization there. But so they don't have a ton of purchasing power now. Their average age is 22. By 2030, they're expected to have $2 trillion in purchasing power in the US, $12 trillion globally. Where is that coming from? Well, they're going to grow up and they're going to make more money, but also there's expected to be a significant transfer of generational wealth.
Anthony, thank you so much for being here. Maybe you can give us sort of a high level, I just gave a little bit on the puts and takes during the quarter, but maybe you could give us a little more color on and how you saw that unfold as the quarter did.
Yeah, of course. Thanks for having me. I think the big headline for me is we continue to see extraordinary demand for travel and experiences. We've been talking about this for the last number of quarters, that it feels like a fundamentally permanent shift, that consumers are prioritizing spending on travel and experiences versus purchase of hard goods. And that phenomenon is really revealing itself in our results. To be sure, the international markets are performing a bit better than domestic. Domestic also had, in the fourth quarter, a little bit of a hit from the government shutdown. But we saw the top end of our guidance range on RevPAR for the fourth quarter and the year. We're guiding to similar RevPAR growth for 2026. And on the growth side of our business, we saw record signings and reported a record pipeline. So the business seems to be firing on all cylinders, and we're seeing particular strength in the luxury end of our business.
Anthony, always good to see you here. Thanks for hopping on after that earnings call.
Nice to see you, Brian.
Likewise. Let's just stay on that high end versus low end. So revenue per available room for Ritz-Carlton, checked on, crushed it. You look at Sheraton, a little bit weaker here. We're showing that on the screen right now. Within your guidance for this year, do you see the low end consumer coming back and getting back into the likes of a Sheraton?
Yeah, I mean, there is certainly, pick your description, K-shaped economy, bifurcation of the consumer. We continue to see really consistent strength across luxury. For the full year globally, we saw 6% RevPAR across our luxury portfolio, which represents about 10% of our global room supply. Just under 3 years ago, we entered the mid-scale tier for the first time. We've got hundreds of hotels open and in the pipeline. And even with that lower income consumer, they are still prioritizing spending on travel and experiences, just in a more economical way. And so I think the timing of our entry into that tier really is working out well for us.
Anthony, you're coming up against what could be a real big moment for Marriott this year, and that's the renegotiation of these credit card fees. You teased a little bit of it in the earnings call, but with these renegotiations, how much more profit will you get as these are renegotiated this year?
Yeah, so there's really two dynamics at play, Brian. The first one we talked about in detail today, and that is we have worked really hard over the last number of years to preserve both the financial strength and stability of the Bonvoy program, but also to make sure we preserve the value proposition for our 271 million members. You combine those two efforts with a recent renegotiation we did of a contract, that's allowed us to increase the royalty percentage of economics that we take into the Marriott P&L. And that's what we talked about at length on the call. Then we talked as well, we are deep into negotiations on renewals of our two important branded credit card relationships with JP Morgan Chase and American Express. We expect to have those done later this year, and that should provide some additional upside, albeit on the base of a credit card program that's the largest in the industry by a pretty wide margin.
And I'm curious, when you look at the cohort of people who hold the credit cards, but also are part of the Bonvoy program, I'm sure you have quite a lot of visibility as to who those folks are. How's that split look in terms of the income spectrum and also the age spectrum? And are those folks then the ones who are spending the most at your hotels?
Yeah, so I think the profile of the credit card holder and the Bonvoy membership more broadly is very diverse. It's very diverse geographically, it's very diverse from an age perspective, and it's very diverse from an economic perspective. But I think your second question is the one that drives more enthusiasm for us, and that is those Bonvoy members who also carry top of wallet a Marriott branded credit card disproportionately spend and concentrate their travel across our broad portfolio.
Anthony, if I have this right, you're working with OpenAI on something, a little bit of a TBD. Is it on the booking experience, and how do you see an OpenAI changing how I book a travel experience?
Yeah, it's AI. We could talk for hours. We look at AI as having the potential to impact our business in three pretty broad ways. I think at the property level, there's an opportunity to both enhance operating margins and create capacity for our associates to better engage our guests in a very personal way. In the above property level, there's a real opportunity to shift some manual processes to using technology to drive efficiency. And then the one that you talk about, Brian, is in maybe some way the most exciting, and that is how is artificial intelligence going to impact how travelers research and perhaps someday book travel. And so we are early stages partnering with leaders, with Google, with OpenAI, to try and figure out and ideally shape how we partner together to allow travelers that are accessing this technology to have access to the full breadth of our portfolio, rich content in terms of narrative descriptions of the properties, photo and video content, so they really can make informed decisions as they start to enter into the booking path.
So we have been talking a lot about how the conditions are prime for an M&A wave broadly this year. And I know specifically in biotech, that's a big topic of discussion as well. What do you see as the sort of conditions that are improving or opening the door for, and you've been doing deals already, but what might make it even a better environment this year?
Yeah, I think over the last 2 years, people have been more stalled in terms of making decisions and investments throughout the biotech industry. I think recent good launches, positive factors in terms of uptakes of drugs are just giving companies more confidence in the ability to be able to identify and launch more drugs successfully. I think there's also a lot more clarity with regard to some of the administration's changes that is still supporting that innovative drugs will be reimbursed and used by patients. And so that really is what led Halozyme in the fourth quarter to complete 2 acquisitions to extend our leadership in subcutaneous drug delivery. And just to say a word in that, Julie, just to introduce Halozyme to the viewers, we are the pioneer of rapid, large volume subcutaneous drug delivery. Many people, and Julie, you may also have somebody, a family friend who's had cancer, has had to go to an infusion suite and sit there all day getting their treatment into a vein. With our current technologies, we can deliver those medicines in just minutes in a simple jab under the skin. Now that can be given in the doctor's office, or it can also be given in the patient's home. And that's with our enhanced technology that's got 10 approvals today and is generating $1 billion in royalty revenues in 2026. But what we are very excited with the two acquisitions is to acquire a hyperconcentration technology from Electrify and Surf Bio that will allow us to further advance care for patients by allowing drugs to be concentrated into an even smaller volume, where they might even be able to be given at home by the patient or by the healthcare professional in a single short injection in seconds. And you can imagine that's going to transform the experience for the patient, for the caregivers, but importantly, reduce stress in the healthcare system by reducing costs and nursing time and free up care for people who need it. So we're very excited for this evolution in patient treatment that we're able to bring forward with subcutaneous drug delivery.
Helen, indeed, I have known people who have had to go to those infusion centers. So the less time that people spend in those, the better, if it indeed is the way forward. I want to ask a little bit more about some of the changes we have seen to funding of biotech and pharmaceutical research, because we've seen obviously some pretty dramatic cutbacks over the past year under this administration. And so I wonder what that does to the pipeline for a company like yours, if maybe it increases the chances of M&A, or that there's more need for sort of corporate funding of that kind of research as the government has stepped back.
Yeah, I would say as we look at 23 and 24, there definitely did seem to be a little bit of a contraction in terms of the development that pharmaceutical companies were doing, and it was harder for biotechs to get money to perhaps develop as broad a portfolio as they wanted. But certainly second half of 2025, we saw more money available for those companies to be investing and developing their own drugs. Pharma is certainly very interested in acquiring late stage to expand their portfolios to address some of the patent cliffs that are coming up for them. And so it is a very good time in our industry for M&A, but very importantly for patients. There are more and more drugs that are now in development, and we're very excited to have the opportunity to be bringing our technologies to those companies. Indeed, in the fourth quarter, we signed deals to make subcutaneous versions of drugs for obesity, for inflammatory bowel disease, and also for a special type of lung cancer. And so companies are investing. It's a great time in the pharmaceutical and biotech industry. We're definitely seeing just an unleashing, I think, of innovation and great interest in making care even more patient-centric than perhaps it was in the past.
What do you think are the characteristics of companies that are potential acquisition targets, both by you and just more broadly in the industry?
Yeah, the data would suggest that there definitely is a bias towards the companies that have gone through the initial de-risking. So perhaps they have gotten into strong phase 2 data, which is the second test that companies do to make sure they've picked the right dose and are beginning to see the safety and efficacy profile of the drug. Or even some companies wait for the full de-risking, which happens at the end of the true test, which is called a phase 3 study that really looks to statistically prove that the drug is working and has a good risk benefit for patients. So a bias towards that de-risking is definitely something the data I was looking at recently was suggesting, and perhaps less on the early stuff that hasn't been de-risked. For Halozyme, the two companies we bought are earlier stage. But what's great is because Halozyme has had such a track record of success in the last 10 years of advancing the first subcutaneous technology that was available for large volume delivery, we're able to apply our expertise to help accelerate the time of development for the Electrify technology and the Surf Bio technology. Indeed, the Electrify technology we expect to be in the clinic with 2 tests by the end of this year, and for this to be a new in hands by the mid-2035s with that $1 billion goal out there by the mid-35s based on the royalties we expect to receive on developing a number of drugs in this simple shot. And I have an example here of the future. We believe for care for cancer, for kidney disease, for autoimmune disease. Imagine instead of those infusion suites I started with, patients are getting their treatment by simply twisting off the cap and then pressing it into their skin. Goes in seconds. That's what we're hoping this hyperconcentration technologies from Surf Bio and from Electrify is going to be able to enable in the next 5 years or so.
Helen, thanks so much for your time. Appreciate it.
Thank you.
Maybe to start, Tim, just big picture, why do brands, Tim, get so excited about the Super Bowl? It's such a marquee event for marketers. Is it, Tim, is it just the sheer volume of eyeballs? You know, is it the type of eyeballs, the demo? Is it the engagement? Walk me through it.
Yeah, I mean, it's the scale, obviously. It's 100 million plus people. And also, it's just a fun, exciting night. You know, people are all about the advertising. When the spots come on, people pay attention. So it's a completely different environment than any other day of the year. And brands love it. You know, as many brands, if you're a CMO, you want to be in the Super Bowl. You probably don't have budget for Super Bowl, but the ones who do, it's a fantastic evening.
What makes an ad often work? Can we kind of boil it down to one or two trends, themes? You know, is it the celebrity appearance? Is it humor? Is it some combination that resonates and hits folks?
You know, I think it's simplicity, either simplicity of the idea, simplicity of the presentation. You know, there's very few ads that break through on the Super Bowl that are complicated. People just don't have time to sort of take in complicated. They're usually at parties. You know, they're not really, they're sort of half paying attention. So if you look at all the great Super Bowl ads over the years, it's really been the ones that have been super simple. And I think that was probably true last night as well. All
right, so keep it simple. How much, Tim, does a Super Bowl ad cost? And do we have kind of line of sight into ROI on all that spend?
You know, this year I think it was about $9 million for 30 seconds, which is kind of crazy. And, you know, to answer your question, no, I don't think there is a clear ROI. You know, this is a real awareness sort of reach play. Very few brands pitch specific products in the game because it's often that's too complicated of a message. So really you're just trying to build fame. You're trying to get your values across. You're trying to entertain people. And those are sort of, you know, soft targets. So it's very hard to measure ROI. However, brand building, you know, is so important. Distinguishing yourself from your competitors on the brand side is critical. And that's, you know, Super Bowl is wonderful for that.
So let's talk about what worked, Tim. You say your top AI ad this year, I think you're probably not alone here. You say it was that Anthropic ad. How come, Tim?
Well, listen, AI is kind of usually pretty pie in the sky. A lot of companies that do it are looking to the future. They've got these grandiose visions. And I think what was great about Anthropic was, you know, it was funny. It was kind of sarcastic. It kind of acknowledged, I think, people's fears about AI, and it really zeroed in on a very specific thing, which is that Anthropic's competitor, OpenAI, is just today, I think, in fact, started serving ads in ChatGPT. So what this ad does, it takes a very specific situation. People generally don't like ads. They don't want to be served ads. This, you know, the Anthropic spot has very little to do with what Anthropic really does or is or could be. It's really about just punching up at the competition. It's a great challenger brand play. I think the ads are hilarious. There's 4 of them at 60 seconds online. They ran as 1:30 in the game. And yeah, I think it was just wonderful for having a very specific point of view, very simple point of view. And to me, the comedy really broke through.
Yeah, I mean, you couldn't help but sort of notice, Tim, the kind of the broad resemblance there between the guy in the ad and I think Sam Altman. I mean, you couldn't help but it landed right there. Let me, on the other side, speaking of Sam Altman, OpenAI, now that one you think, Tim, it kind of came up short. Why? Why did that, in your opinion, sort of kind of miss the mark?
Yeah, you know, I think this was an example of an ad that's really just sort of a montage of images. It doesn't say anything very specific. It's sort of aspirational, but it's unclear kind of who it's for. I think they really, you know, this is obviously the message they wanted to send, which is, you know, humanity is heading in this wonderful direction. Our product can help you. But to me, you know, it just didn't have a very specific point of view or something to say, unlike what Anthropic did. So I think this one, and most of the AI ads on the game, honestly, were not super targeted. And I just think they lost the plot a little bit. People are not that comfortable with AI. They want to be sort of reassured about it. And, looking at it through this lens of like it's going to change humanity, I don't know. To me, that kind of rings a little false for most viewers. This particular ad promoted Codex, which is a new app that OpenAI has. Maybe it's wonderful. It probably is. I'm sure it's super powerful, but I don't think it really connected with people in the way that the humor of Anthropics did.
How about Coinbase, Tim? How did that score on the Tim Nudd scale?
I actually love Coinbase. Listen, like the thing about Super Bowl lately is almost every marketer has the same playbook. These very, very familiar, throw 5-10 celebrities in the commercial. This took a completely different tack. This is a 60-second ad. The first 53 seconds are unbranded. It's Backstreet Boys karaoke. I think a lot of people joined in. It was just meant to be for fun. I'm not going to say that this ad was the greatest success of the evening. I think once the Coinbase name popped up, some people were a little deflated. But listen, it's unlike any other Super Bowl ad that you saw last night. It pops off the screen because the visuals are so janky and weird, unlike the high gloss of everything else. And, I love it. I love seeing any brands that want to take a risk. Very few brands do that. Coinbase had the bouncing QR code 4 years ago. I don't know if you remember that one, but also very unusual. So, kudos to them for trying something different, whether it worked or not.
All right, it wasn't just crypto and AI, right? You also you got the classics, Tim, right? You got the beer and potato chips, Budweiser and Lay's. How'd they do? Winners, in your opinion?
Absolutely. They did wonderfully. A big part of Super Bowl is these heartwarming ads. Budweiser has nailed it for, 30 years now. I think this is one of the best Clydesdale ads they've ever run. They went away from Clydesdales for a couple of years, and it's no surprise to me that they're back. Everybody loves the familiarity of these horses. This had a lovely, America 250 kind of tie-in with the eagle. It's got, it's the bird story. It's sort of a retelling of the puppy ad they had about 10 years ago that was super popular. So I really like this one. I think it won the USA Today Ad Meter, which is a ranking that a lot of marketers look at. And then Lay's also, it tells a family farm story. Really wonderfully shot. Taika Waititi shot this one. Very nostalgic, wonderful, great pacing on the storytelling. Just a great family story. And a lot of viewers on Super Bowl really want this kind of stuff. So it's either this kind of stuff or comedy. Those are the two things that sort of break through usually on Super Bowl. And when it's done well, these spots the day after, a lot of people are talking about them.
How about Michelob Ultra and State Farm? Because it doesn't sound, Tim, like you love those ones.
I didn't love those ones. And it's a shame because those two marketers are usually really great at what they do. Like a couple years ago, State Farm had the Arnold Schwarzenegger ad. It was wonderful. Last year, they had the Batman versus Bateman one. I think this one just kind of fell short. And Mick Ultra, to me, I know it did quite well on the ad meter as well. To me, it was just kind of a mishmash of, celebrities, athletes. You had the Kurt Russell sort of bringing back the miracle character. To me, the pieces didn't really fit together that great on this. I think they're trying to be, obviously they're trying to be Super Bowl and also Winter Olympics. This ad's going to air during the Winter Olympics as well. So I guess it has all the strategic parts they were looking for, but to me, it didn't really quite break through. I think it was just a little bit of celeb overload in this one.
Tim, appreciate that rundown and that summary. Thank you.
Appreciate you. Thank you for having me.